Imagine a financial tidal wave is currently building on the horizon, invisible to the untrained eye but destined to wash away the savings of the vast majority. For most individuals, this period will be remembered as a time of profound loss, yet for a select few, it represents the single greatest chance to accumulate wealth they will see in a decade. We are entering a rare window of opportunity that only swings open roughly once every 10 years, and it is specifically designed for the regular person rather than the giants of Wall Street or the billionaire class. To capitalize on this, you do not need a massive bankroll or a genius-level intellect. Instead, you require a clear-headed grasp of the mechanics currently in motion. Right now, we are witnessing the very beginning of a cycle where the metaphorical price tags on the world's most valuable assets are being slashed. It is the start of a massive sale, yet most people are too distracted by the noise to notice the doors have opened. History functions like a recurring script where major recessions and market crashes serve as the ultimate wealth redistributors. If you look back at every significant financial crisis, you will find a specific cohort of people who emerged on the other side with life-changing fortunes. They did not do this through luck, but by viewing a crisis as a liquidation event for high-quality assets. While the general public is conditioned to retreat when the economy stutters, the savvy investor recognizes that a crash is simply the market offering a steep discount. The fundamental strategy is to identify which assets are being unfairly punished by the chaos and to execute a predetermined plan while the rest of the world is sprinting toward the exits. The primary obstacle standing between you and this wealth is not a lack of capital, but the biological urge to succumb to fear. When the economy slows and headlines turn grim, the natural human instinct is to freeze. People tend to pull back, strip their money away from any perceived risk, and hoard cash in a desperate attempt to find solid ground. This is what I call the safety trap. The irony of investing is that by the time the world feels safe again, the opportunity has already evaporated. If you wait for the news to tell you the coast is clear, you are already too late because the prices will have reflected that new reality long ago. To understand the sheer cost of hesitation, look at the data provided by J.P. Morgan regarding the S&P 500. Imagine you had invested $10,000 into the market during the 20-year window spanning from 2003 to 2022. If you simply held your position through the volatility, that initial sum would have blossomed into $64,844. However, the tragedy occurs when investors try to time the market out of fear. If you had missed just the 10 best trading days during those 2 decades because you were waiting for things to feel more secure, your final return would have been cut almost exactly in half. The most explosive gains often happen in the immediate wake of the most terrifying drops. This is why having a long-term roadmap is non-negotiable. I am not a financial advisor, but the numbers make one thing clear: wealth is built by those who have the courage to buy when the world is panicking and the discipline to stay the course when the headlines are screaming for you to run. The global economy effectively hit a brick wall in early 2020 as every gear of industry ground to a halt. In that sudden silence, commerce vanished and consumers retreated into their homes. The financial markets reacted with a violent shudder, causing the stock market to plummet roughly 34% in a mere 30 days. This collapse was not just a typical decline, it earned its place as one of the swiftest and most aggressive market disintegrations ever documented. To prevent a total systemic failure, global authorities and central banks adopted a blunt strategy: they saturated the financial plumbing with immense liquidity to prop up falling demand. Specifically in the United States, the supply of money expanded at an unprecedented scale between 2020 and 2022, while the cost of borrowing was slashed to effectively 0%. Think of this era as the ultimate open bar event for debt. When capital costs nothing, everyone lines up to fill their glasses. Corporations leveraged up to chase aggressive growth, families signed for mortgages to secure real estate, and speculators borrowed heavily to pour money into equities. This massive influx of synthetic wealth flooded every corner of the market, forcing prices into a vertical climb. The hangover from this spree was the most intense inflationary surge in 4 decades. By mid-2022, the United States saw inflation peak at a staggering 9.1%, a level of heat the economy had not felt since 1981. This meant your purchasing power was being devoured in real time, a basket of goods that would have cost you $100 in early 2020 was suddenly demanding a far higher price tag just 24 months later. To extinguish this fire, the Federal Reserve had to turn off the liquidity tap and execute a sharp policy reversal. Between March 2022 and the middle of 2023, they aggressively hiked interest rates from near zero to above 5%. This transition represents one of the most rapid tightening phases in the history of finance. The impact was immediate and punishing. The stock market buckled, real estate growth stalled, and tech companies that had been trading on nothing but hype saw their bloated valuations evaporate. The cryptocurrency sector was decimated, losing more than 70% of its value from its all-time high, while the bond market suffered a loss of value that investors had not seen for generations. During this period of intense pain and paper losses, most people simply panicked and retreated. But what was actually happening beneath the surface of that chaos? High-quality assets were effectively being marked down in a massive liquidation event. Imagine if a premium dealership suddenly decided to sell its fleet of luxury vehicles for 30%, 40%, or even 50% off the sticker price. You would likely be the first person through the door, yet when the same thing happens to the S&P 500, people tend to run away. From its peak in late 2021 to its trough in late 2022, the S&P 500 shed approximately 25% of its value. This created a scenario where companies worth $1 were being traded for just 75 cents. These were the same businesses with the same loyal customers and identical revenue streams. They were simply being sold at a discount because fear had replaced logic. While many weak businesses were being correctly discarded, the market was also tossing out powerhouse companies with massive competitive advantages right alongside the trash. That specific overlap of panic and value is where life-changing opportunity is born. The staggering sum of $68 billion was deployed into the equity markets by Berkshire Hathaway in a single calendar year. While the average retail investor was paralyzed by the volatility of 2022, Warren Buffett, widely regarded as the premier long-term investor in our history, was busy weaponizing his famous mantra to be greedy specifically when the rest of the world is gripped by fear. This massive capital injection was not the act of a reckless gambler, but the calculated move of a veteran who recognizes that market cycles are as predictable as the changing seasons. Success in this arena is rarely about having the highest IQ. It is about the iron discipline required to ignore the collective panic of the crowd and focus on the cold, hard data of the cycle. If we look toward the stock market today, we see a landscape that has been significantly leveled. The absurd, gravity-defying valuations that characterized the COVID bubble have largely been purged, leaving behind fertile ground in sectors like healthcare, energy, financials, and consumer staples. These specific industries have been forced to price in a level of catastrophe that often fails to manifest in reality. The most reliable blueprint for building a fortune remains unchanged: acquire high-caliber assets when they are bruised and unloved, then simply wait for 5 to 10 years. Rather than attempting the impossible feat of catching the exact bottom of a crash, savvy participants use a method akin to a slow-drip irrigation system for their capital. By investing a set amount on a rigid schedule, you bypass the emotional wreckage of market timing and ensure you capture the broad, upward trajectory of the economy. Evidence from Vanguard supports this disciplined approach, showing that a balanced mix of American stocks and bonds, adjusted just once a year, has historically weathered every storm from global pandemics to geopolitical collapses. Consider the math of procrastination: starting a $500 monthly contribution today and maintaining it for 3 decades creates a massive financial fortress. However, if you hesitate for even 5 years before beginning, the final mountain of wealth you end up with will be significantly smaller. In the world of compounding, time is the only truly irreplaceable resource, making the present moment the most lucrative entry point you will ever have. Turning our attention to the property market, we find a much more tangled and peculiar set of circumstances. The period between 2020 and 2021 saw a frenzy of home buying fueled by ultra-cheap debt, which sent prices into the stratosphere. When mortgage rates subsequently leaped from roughly 3% to over 7%, the monthly overhead for a standard home effectively doubled overnight, crushing the dreams of many prospective buyers. This has created a frozen market where volume has evaporated. Owners are clinging to their low-interest loans like life rafts, while buyers find themselves stranded on the shore by current costs. Yet, the essential truth is that interest rates are not a permanent fixture at these heights. Historical patterns dictate that they move in waves, and the current peak is just that. Interest rates don't stay high forever. When rates eventually come back down, and based on historical cycles, they will, all those buyers who are sitting on the sidelines right now are going to flood back into the market at the same time. Investors who successfully navigate the current housing market are effectively purchasing a ticket to future prosperity. While the rest of the world waits for the storm to pass, those who can manage their spreadsheets to accommodate today's higher borrowing costs are essentially front-running a massive recovery. When interest rates eventually retreat, as the historical pendulum always ensures they do, property values are poised for another upward surge. These forward-thinking individuals are not just buying buildings, they are essentially harvesting the discord of the present to plant seeds for a massive windfall during the next period of normalization. It is the equivalent of climbing a mountain during a gale so you can be the first to see the sunrise while everyone else is still huddled in their tents at the base. Beyond physical assets, your most potent engine for wealth generation is not tucked away in a brokerage account, it is located right between your ears. Your fundamental capacity to produce income remains the ultimate catalyst for financial freedom. When you increase your earning power, you create a wider pipeline for capital to flow into investments, effectively lengthening your runway for long-term compounding to perform its magic. In a constricting economy, companies prioritize those who possess high-leverage skills like coding, sales, marketing, and finance, talents that translate directly into top-line revenue. While the general workforce faces the threat of layoffs, those with specialized expertise often find themselves receiving promotions and raises. The return on investment for self-education often dwarfs the gains of any speculative coin or trendy stock. Consider the findings from Georgetown University, which reveal that a bachelor's degree typically correlates to an extra $1 million in lifetime earnings compared to a high school education. However, the modern landscape offers even more targeted shortcuts. For a few $100s spent on online certifications in data analysis, software development, or artificial intelligence tools, you can unlock an immediate and massive income premium. Treating yourself as a capital asset is the most logical move in a volatile world because your skills are the only portfolio that can never be seized or liquidated by a market crash. However, many people hit a wall because they assume every price drop in a recession is a bargain. This is a dangerous fallacy. A stock that has collapsed by 50% might still be incredibly expensive if it was originally trading at a delusional valuation during a bubble. To separate the true opportunities from the traps, you must look at the price-to-earnings ratio, a metric that serves as a reality check for investor expectations. This figure represents exactly what you are paying for each dollar of a company's profit. For example, a $15 share price for a company earning $1 per share gives you a ratio of 15. Over the last century, the S&P 500 has averaged a ratio between 15 and 17. During the 2021 frenzy, these numbers skyrocketed far beyond their historical anchors, signaling a classic bubble. Following the 2022 reset, many sectors have finally returned to or even dipped below these long-term norms, providing a clear green light for those watching the data. Does this business make real money? Does it have customers who pay it regularly? A fundamental shift in the landscape occurs when you identify a business that remains profitable and retains a loyal customer base despite a plummeting share price. When a company maintains a healthy surplus of incoming cash compared to its operating expenses, a market-wide panic creates a rare entry point for the disciplined observer. Conversely, many enterprises that appear to be on sale are actually toxic traps. These entities typically hemorrhage cash, possess zero path to profitability, and only stayed afloat by gorging on ultra-low-interest debt or the blind optimism of speculators. For such fragile organizations, even a steep price drop is rarely a deep enough discount to justify the risk. You do not need the credentials of a Wall Street analyst to separate the wheat from the chaff. By utilizing free digital resources like Yahoo Finance or Morningstar, you can conduct a basic health check on any public entity. Dedicating a mere 30 minutes to auditing the core financial statements before deploying your capital is the ultimate insurance policy against the mistake of catching a falling knife simply because it looks cheap. Beyond the selection of individual assets, a massive and often overlooked wealth accelerator exists within the tax code of the United States. For investors under 30, understanding tax-advantaged accounts like the Roth IRA and the 401 can be worth tens of thousands of dollars over a career. The mechanics of a Roth IRA are particularly powerful, because you contribute funds that have already been taxed. Every subsequent cent of capital appreciation, every dividend payout, and every reinvested return is entirely shielded from the government when you withdraw it during retirement. If you deposit funds today and they multiply over 3 decades, your tax liability on those gains is exactly zero. A traditional 401 offers a different but equally vital edge by allowing you to contribute pre-tax income, which lowers your immediate tax bill. Furthermore, many employers offer a match, such as 50% on the first 6% of your salary. This is effectively a guaranteed 50% return on your investment before the money ever touches a single stock or bond. When markets are down, these accounts become even more effective, allowing you to acquire a larger volume of shares that will grow in a tax-sheltered environment for the next several decades. Securing your full employer match should be your absolute first priority in any wealth-building journey. Turning to the more volatile frontier of digital finance, the period between 2020 and 2023 stands as one of the most aggressive boom-and-bust cycles ever recorded. At the height of the frenzy, the total market capitalization of the cryptocurrency sector surged to approximately $3 trillion. However, as the era of cheap money ended and liquidity was drained from the system, the market bottomed out below $800 billion in late 2022. This collapse exposed a harsh reality. A significant portion of the projects marketed as revolutionary breakthroughs were merely speculative bubbles hidden behind layers of complex technical jargon. As the support of low interest rates vanished, so did the inflated valuations of these unproven assets. A lot of projects that looked like revolutionary technology turned out to be speculation dressed up in technical language. The entire market feels like it is falling apart, then that specific stock might just be an incredible bargain hiding in plain sight. This brings us to the digital frontier where Bitcoin and Ethereum are no longer just internet curiosities but have proven their staying power through genuine technological utility. We have entered an era where the giants of traditional finance are not just watching from the sidelines but are actively offering Bitcoin ETFs to their clients. This shift marks a definitive transition into mainstream acceptance that was unthinkable a decade ago. However, the golden rule here remains centered on a single concept, and that is diversification. Think of cryptocurrency like a high-powered spice in a complex dish. A little bit can transform the profile and add incredible zest, but if you make it the entire meal, it becomes completely unpalatable and dangerous. Because these assets are defined by extreme price swings and high risk, they must only occupy a minor corner of your total financial picture. If you are currently in the stage of life where you are aggressively building your net worth, most seasoned financial professionals would suggest capping your exposure to alternative assets at a maximum of 5 to 10%. The bedrock of your survival and eventual prosperity must be built on the unglamorous work of consistent index fund contributions, maximizing your tax-advantaged accounts, and holding physical or digital assets that possess undeniable fundamentals. While these methods are often described as boring or slow, they are the only ones with a proven track record of creating lasting security. It is perfectly acceptable to include speculative plays as a small slice of your strategy, provided you have done the deep research, but you must never allow the volatile roof of the building to become its foundation. Now we must examine the actual mechanics of how people who successfully accumulate wealth operate on a daily basis. You might wonder what these individuals are doing differently while everyone else is glued to the red numbers on a television screen. The truth is that wealth is not a product of a single lucky moment or a secret tip. It is the result of a specific psychological framework. When a recession hits, the average person sees a threat to their lifestyle and retreats into a shell of fear. The wealth builder, however, views a market crash as a massive clearance sale at a luxury store where everything is suddenly marked down by half. They do not wait for the news to tell them it is safe to come out because they know that by the time the headlines are positive, the best prices will have already vanished. It is about maintaining a logical distance from the collective panic. While the world is shouting that the sky is falling, the disciplined investor is quietly calculating how many more shares of a great company they can acquire with their monthly savings. Success is not about being the smartest person in the room, it is about being the one who can control their emotions when everyone else is losing theirs. It is just those things done consistently over a long time. Assets have been fundamentally transformed by the aggressive shifts in the interest rate landscape we have witnessed over the last couple of years. For more than a decade, specifically from roughly 2009 to 2022, the world of fixed income felt like a parched desert where investors were lucky to find even 1% to 2% returns. During this long stretch, bonds functioned less like a growth engine and more like a stagnant pool of capital that offered almost no utility for those seeking real wealth. However, the scene changed drastically as interest rates surged throughout 2022 and 2023. This sudden ascent pushed yields on government debt and high-quality corporate bonds. Time has a way of acting like a reverse magnifying glass for the economy. When you are standing right in the center of a financial storm, every month of red charts feels like an eternity of chaos, but if you zoom out far enough, those terrifying years shrink into tiny blips on a much larger upward trajectory. The individuals who actually manage to stack significant capital during these volatile stretches are not superhuman or devoid of emotion. They feel the same gut-wrenching anxiety as everyone else, but they distinguish themselves by operating through a mechanical framework. They rely on an automated protocol that keeps their capital moving into the markets even when their own instincts are screaming at them to hide. Consider the historical evidence to see why this cold, systemic approach is the only logical way to view your portfolio. Let us dissect the anatomy of previous disasters to ground these concepts in reality. During the infamous collapse of the tech sector in 2000, the markets suffered a staggering 49% decline. It was a mass exodus where a vast number of participants liquidated their holdings and swore off the stock market forever, effectively locking in their losses. However, the minority who ignored the headlines and maintained their contribution schedules throughout that valley did more than just survive, they eventually crested into a period of massive profitability. The 2008 global financial crisis provided an even more brutal stress test, ranking as one of the most severe contractions in our modern era. The S&P 500 plummeted 57%, leaving investors staring at account balances that had been sliced by more than half on paper. Yet, the rebound was relentless. By 2013, a mere 5 years later, every cent lost had been reclaimed by the market. Those who viewed the crash as a clearance sale rather than a funeral made life-changing gains because they were accumulating assets at rock-bottom valuations without needing the impossible foresight to time the exact moment of the reversal. Even when the speed of the crash is unprecedented, the recovery often matches its intensity. The pandemic-induced shock of March 2020 saw the market surrender 34% of its value in only 30 days, bottoming out on March 23, 2020. Despite the global uncertainty, the entire deficit was erased by August of that same year. By the time 2020 concluded, the markets were trading at levels significantly higher than the spring lows. We see the same engine at work every single time: prices collapse, panic becomes the dominant social currency, and the majority of people either freeze in indecision or commit the cardinal sin of selling at the bottom. Meanwhile, a silent cohort keeps buying. This cycle is a revolving door where those who stay the course or increase their exposure emerge in a far superior financial position than those who fled. Over a century of data confirms that this type of rigid, long-term discipline through every phase of a market cycle is the most consistent path for a typical person to generate real wealth. This brings us to the present moment, where we are currently navigating the internal gears of a live cycle. Interest rates have climbed significantly, markets have undergone painful corrections, and the prevailing sentiment is one of deep apprehension. The headlines are designed to keep you in a state of alarm, but from a purely analytical standpoint, this environment suggests we are much closer to a massive entry point than we are to a missed opportunity. Think of the economy not as a straight line, but as a pendulum that has swung into a zone of high tension. We are witnessing a fundamental recalibration where assets are being priced more realistically, and in many sectors, quite cheaply compared to the last several years. This is a signal to sharpen your focus rather than look away. The post-downturn years are historically where the most profound wealth creation occurs, not as a result of a lucky roll of the dice, but because specific people recognized the mechanics of the cycle and executed a predetermined strategy. To capitalize on this, you should view the landscape as a three-pillar structure of opportunity. First, the equity markets are currently offering stakes in high-quality enterprises at valuations that were unavailable during the frenzy of the previous peak. Second, the real estate sector is currently in a holding pattern where those with the courage to acquire property now stand to reap the rewards when interest rates eventually pivot downward. Third, and most importantly, is the enhancement of your own earning power and professional expertise, which serves as the bedrock for every other investment you make. The most damaging error you can commit right now is hesitating until the world feels safe again. By the time the general public feels comfortable, the discount period has ended, the recovery is already priced in, and you are simply buying the top of the next expansion. Building a fortune is an endurance race measured in decades, not a sprint measured in months. You do not need to be born into money, you do not need to be a genius at market timing, and you do not need to gamble on a single moonshot stock. Success is reserved for those who show up, stay in the game, and refuse to quit when the environment gets hostile. The doorway to the next decade of growth is currently standing open, and the only relevant question is whether you have the resolve to step through it. If this breakdown has provided a clearer lens through which to view your financial future, ensure you are subscribed and move directly to the next video to continue your education. As a necessary reminder, I am not a financial advisor. This content is provided strictly for educational purposes, and any financial outcomes you experience will be the direct result of your own independent choices and actions.